This is probably going to be one of the craziest day in the stock market. We can see right now pre-market Amazon is up 8.4%. Yes, a multi-trillion dollar company is up nearly 10% on pre-markets. We can also see companies like Apple up 6.4%. Other big giants like Microsoft. Microsoft is maybe a little bit of a laggard just because it doesn't have too much to benefit with the recent news up 2%. Now on today's episode, what I want to do is take a closer look at what we know about the trade deal that happened with the United States and China, and what are some things investors should consider, because let's be honest, it's not all perfect right now and there's still room for things to change. So obviously super excited right now and super happy to have the market opening in a few minutes from now, but there are things investors should consider. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
Obviously, you guys know I am a huge semiconductor investor. So I am happy to see NVIDIA up 4.4% back to $120. We do see Qualcomm, a very popular company in the semiconductor stock market, up 7%. And we do see AMD up about 6.7%. So in my opinion, right, one of the big winners of this trade deal that has kind of happened right now with US and China at the moment is very beneficial for a lot of consumer tech electronics and for kind of like the consumer spending market. That's why you do see kind of a lot of excitement happening in semiconductor companies, as semiconductors tend to go in pretty much all consumer tech. So you see AMD and Qualcomm up a nice amount. That's why you also see companies like Amazon and Apple, who are also very consumer centric, to benefit a nice amount, opposed where Microsoft, which is more software centric and stuff like that, is only up about 2%. So I do believe the semiconductor space is going to be one of the biggest ralliers. I don't even know if that's a word, but one to rally the most during the overall space right now. So on yesterday's episode, or last night's episode, I talked a little bit of how the US and China got into a trade deal. Now we do got the specifics earlier this morning, and I want to go into a little bit more detail about them. So both nations agreed to temporarily slash reciprocal tariffs. Remember, and now this is where I mentioned, and we'll talk about it, this is at least temporarily at the moment, but it does open up the opportunity where now it's no longer kind of like a battling match back and forth. Now there is some form of tameness happening between the US and China, that as a temporary in some of the things that they had pushed in the past, now it opens up for more neutral and a more calm environment to make a better deal. So under the agreement, the U.S. will reduce tariffs on Chinese goods from 145% to 30%. We have heard tweets and X's and reports from Scott that right now this kind of 10% flatline tariff on China and baseline tariffs is a floor, and there is a floor for China at the moment. So it doesn't seem like it could get better from here, and that's some of the talks we are hearing right now that are kind of reporting on real time. Now, China will cut its tariffs from 125% to 10%. Now, remember, the extra 20% the U.S. has on China is because of the fentanyl extra tariff of 20%. If not, the baseline tariff would also be 10% there. So it does seem like at least they agree that there has to be some tariffs for that fentanyl situation of national security, and they're willing to kind of have this difference between the 30 to 10%. But on the baseline approach, I do believe both countries are at a 10%. Now, these rates will apply for 90 days as negotiation continues, with the US baseline tariff remaining at 20%. The deal also suspends non-tariffs countermeasures, including China's rare earth export restrictions and blacklisting of U.S. firms. So overall, we can see some great excitement. And again, I think one of the biggest things that's happening is many investors were expecting something like this not to happen so soon. We were expecting this to just be talks and kind of a framework, but it actually brought into some actual numbers. And even though it's temporary for 90 days, is probably a lot better than just a framework. And now this opens up the world for more of a better deal to happen throughout the upcoming 90 days. Now, the real question is, what is U.S. going to end up winning out of this, right? Why did the tariffs start it? Are we just backing off on everything? Remember, at least right now, we do have a higher tariffs on China, so that could be something that the current administration could kind of push on, saying, look, this is what we're doing, and we're still going to get more money out of it. Now, we did see a lot of stocks rally like crazy, right? I mean, we saw some semiconductor stocks up near the 7%. Why is this happening? Obviously, we talked about a trade deal being really good, but the most important thing is analyst expectations versus reality. The agreement exceeded most analyst forecasts. For example, JP Morgan was noting that their expectations had been that the tariffs would come down to 50 to 60% rather than 10 to 30%, right? So there was a big beat there compared to what some analysts were expecting. The second thing is Deutsche Bank called the outcome better than their optimistic expectations. So the banks, the people that have all these ratings and marking data, these were left I don't know, blindsided, but this was great news for them, right? These expectations that we got right now, the 10 to 30, were a lot better than the market was expecting. So overall, you did see kind of a great positive reaction. And again, the 90-day timeline was seen as ambitious, but it does maintain negotiations momentum. So there is still that doubt, and I think that's what investors are going to want to consider. How is it going to be possible for a real trade deal to happen after these 90 days? I do believe both countries really need each other. So there is that push and that nice tailwind from both countries that, yes, we need to make a deal. The sad thing is I do believe both countries tend to be very hot-headed as well. So in these 90 days, we can get a lot of volatility. And I think that's what the market is still expected. Since there's no trade deal at the moment, there's still a lot of room for what ifs and different meetings that someone can say the wrong thing and things can implode in the meeting and stuff like that. So the volatility, in my opinion, is still there and something investors should consider. So I also have some other implications for stock investors. First, short-term rally potential. Like I mentioned earlier, I do believe the big winners are going to be the tech space and industries that have a nice gain due to reduced import costs. Typically, kind of like your Amazons, like I mentioned, your consumer tech players. You see Apple and a lot of semiconductor stocks up a nice amount pre-market. In the moment, I do believe there is going to be some reduced volatility, right? The deal eases immediate recession fears. One of the biggest things happening right now was all these increase in prices. What was it going to do with consumer sentiment? What was it going to do with any fears of recessions and stuff like that? But now, as things have calmed down, those recession fears, at least at the moment, can be pushed out to the other side. So a reduced volatility on that, but there's still volatility that, in my opinion, can happen due to the numerous amounts of times that these two entities are going to meet against each other. Now, sector diversions, I do believe, again, this is going to be pretty interesting right now. Based on these tariffs pushing back down, domestic-focused U.S. firms may lag behind multinational benefiting from the tariff relief. Right now, if it's, again, still much cheaper to produce a lot of these things due to tariffs in other parts of the world outside of the United States, it's going to be kind of a whole, hey, let's just continue to do this in the other parts of the world. And again, I do believe maybe things like that, or hoping maybe stuff like that gets fixed during the actual trade deal. Now, the long-term risk is the 90-day window creates event risk, with tariffs potentially being restated if talks stalk. Investors should monitor a lot of this in the supply chain progress on non-tariff measure. And there are still some issues unresolved. One of the first ones is like IP protection was something that was expected to be covered a lot. Subsidies and export controls. We have things like the AI chips. We still have no real confirmation on anything like this at the moment. So all that is also going to create some more volatility. So I do believe this year is still going to be the year of volatility, and we're going to continue to see things like this, where obviously this is great news, but it's not the ultimate perfect news, and it's not something that can eventually turn around and be created as a headwind in the future. But right now, let's enjoy how the market is doing. I just want to see NVIDIA up again, 4.5%. I also want to see AMD up again, just to see nearly 7%. Again, AMD is a little bit more dependent on the consumer market. That's why you would see a company like AMD up a nice amount. Now, I am curious about your favorite semiconductor stock. Intel is up about 4% right now. Now, the final thing I do want to talk about is analysts are predicting a front loading effect as businesses rebuild inventories, potentially boosting kind of shippers in the short term of things. The main thing to remember is U.S. China container shipments plummeted a huge amount in April of 2025 due to the overall tariffs, right? And this whole kind of economic mess that was going on. Now, it's not like shippers built new ships out of nowhere, so there's still only a limited amount of ships. But I do believe we're going to see some front loading happening as maybe a lot of companies are going to want to buy a lot of product between these 90 days, just in case things go back wrong. But at the same time, you're going to, in my opinion, there's going to be maybe too much product coming in. And do we have the supply chain in forms of shippers, in forms of truck drivers, in forms of railroads to be able to move the huge demand that might be coming right now? And this front loading effect, it might not be sustainable, as it might just be kind of ordering a lot of stuff ahead of time just in case they don't need to order it later on. So I do believe this can also create a lot of noise in consumer tech, and maybe it can create maybe some bullish sentiment where it might just be kind of front loading happening due to the fear of these tariffs. So again, this just creates, in my opinion, so much more fun for the market, as we're going to have to see what's really going on in the upcoming earnings call. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you all next time.